Welcome, everyone. This should be interesting. I've got some things in the presentation that are both informative and hopefully entertaining. So let's start. Internal rate of return, net present value. Most of the time, it's used very simply to make a financial decision of some sort. The question is how. Gonna be one of those days. Neither way. The keyboard's not responding either. Okay. Yes. Okay, there we go. Okay. Technical difficulties. Okay. This presentation, I'll go through a bit of history of IRR and NPV, some of the basics, definitions, the basic formulas that are used for net present value and internal rate of return. I do have various uses and also some examples, and then we can go from there with the closing remarks. First of all, before we get started on this one, how many people here have heard the term internal rate of return or net present value? Okay, that's kind of what I expected. How many people have actually had to use it? Good. And one final question on that line. How many of you think it's a tool put together by financiers and accountants? Okay. This may surprise you. The original person who started developing these techniques was actually an engineer, a civil engineer by the name of A.M. Wellington. And he worked for the railroad in 1877 and put together some tools for him to help make some decisions on where he was going to put where they were going to put the railroads and how they were going to be installed. Also followed up and by John Charles Lounsbury Fish in 1923. Again, an engineer. Additional development work done by Irving Fisher in around 1930. Irving Fisher was the first economic PhD given at Yale University. And in the 1970s, about 3/4 of the Fortune 500 companies were using these kinds of tools to make their financial decisions as to what projects and programs that they were going to support. First reference in accounting was in 1982. So as you can see, the financiers and the accountants are really late coming to the game. And it was significant use was made by the Finnish schools in the 1980s. One additional thing here, and that is even though all of this is going on globally, the Japanese did not use these tools until much later. So let's talk about basic equation. Obviously, interest is a very simple one. And if you're starting with a value now, put it in the bank, they're going to pay you interest. You get a little bit more in the following year. For most of what I'm looking at, I typically use 5% because it's just an easy number to calculate. So we start with $1 and put it in the bank for a year. We get $1.05 back. Conversely, if we have a future value and we want to know what that's worth now, we just change the equation a little bit. And this one will become more significant as we go forward. Again, same thing. $1.05 in the future divided by 1 plus the interest rate gives you $1 now. Very straightforward. So what truly are NPV and IRR? Net present value, that's what you're doing with the net present value is you're taking all of your future payments and future cash and converting it to a value for today. Internal rate of return, on the other hand, is okay, I have a whole bunch of cash flows. Now, what gives me a zero cost? I'm not gaining or losing money, but the program or project is essentially paying for itself. Both of these are used in capital, what's called capital budgeting. And this is the process that most companies will use to determine whether a particular program or project is worth going into. And numerically, as you can see, we've got the same kinds of calculations in terms of NPV, in terms of the NPV for each period that we're looking at. And where the C's are cash flows, and you're dividing by the interest rate. And this goes on, obviously, for as many periods as you need. Could be 5 years, could be 10 years, could be 50. It just depends on what you're looking at. And let's simplify this a little bit and go down to a little bit more standard notation. Now, internal rate of return. This one is a little different, not so much in terms of the form, but in what we're trying to calculate. You notice that we've got IRR in each one of these divisors, and this, because of this, the solution to this kind of a problem becomes iterative. So you're just going to play with the numbers until you figure out what the value for IRR is. It gives you an NPV of 0. And again, we can simplify the math, simplify the presentation of the math by just summing it. Now, IRR is used to estimate the profitability of potential investments. So if you're looking at an investment, what do you expect as a return? Is it 5%? Is it 10%? Or is it 20%? Or is it even negative? Very useful in comparing multiple projects. So say you've got 2 projects that are sitting in front of you. Both of them are $1 million each. Okay, one that has an IRR, an internal rate of return of 5%. The other one has an internal rate of return of 8%. Which one are you going to choose? From a financial standpoint, it'll be the 8%. And then it can be used in situations where it's difficult to determine a discount rate. So if you don't know, if you don't have an idea of what your discount rate is, and I'll get to that in a minute, then it makes it very easy because it's going to give you a direct calculation of what the expected rate of return is for those particular projects. Net present value, on the other hand, is used in situations where there are varying directions of cash flow, some positive, some negative. This happens a lot when you're starting up a new program or you're starting your own business. First couple of years, probably you're not going to make any money. As a matter of fact, you're probably going to spend more money than you make. Net present value can also be used in situations where there are multiple discount rates. So if you have different parts of the project over different time frames, say first 3 years, your interest rate is 5%. The next 3 years, your interest rate is 8%. You can use those numbers and calculate the present value based on those interest rates. Let's say somebody comes up to you and says, hey, I got a great deal, a great investment in a mine. Well, this mine's a little questionable, but we'll take a look at it anyway. So he comes to you and says, I only want you to invest $50,000. Okay. And then I'll pay you these payments, 20,000, 15,000, 8,000, etc., for the next 6 years. And you look at it and say, okay, is this a really good deal for me to get into? Really don't know. You can say cumulatively, you're actually making money because at the end of 6 years, you have $46,000, which is more than you start, which is recovery of your investment plus, a couple of years. So you're doing okay here. So let's take a look at it from the standpoint of an internal rate of return. First thing we want to do is we figure in year zero, we're making our investment purchase $50,000. Then we've got our payments coming back each year for the next 6 years. And what we're doing, going back to the internal rate of return formula, is we're dividing each one of these by 1 plus whatever the interest rate is, raised to whatever power the year is. So for the first year, obviously, it raises the first power. It's going to be just divided by the interest rate. And you continue on down. And when you get done with this, your sum, everything comes out to be 0. And you have, on this particular investment, an 18% rate of return. Now, is that good? Again, it's questionable. Because if you're really worried about your investment, it may not be a high enough return for you. If you're not worried about your investment, yeah, great return. And if you take a look at the cash flows, you'll notice that as you go through the years, the cumulative value crosses the 0 mark at between years 3 and 4. So at that point, you've made your return back, and now you're really making money. So again, from a financial standpoint, can you stand that money being out there for 3.5 years or so? That may be part of your financial decision, which comes out of this. All right, now we've got a slightly different situation here. Say your manager comes to you and says, I've got these 2 trucks that I need you to take a look at. And I need to know which one's the better value, which one we should be buying. Okay. You end up doing the same thing. This is truck F. I'm playing with a little bit here. Truck F and truck G. You people who are in the trucks, you can kind of know where I'm going with that. So again, first year, truck's going to cost you $50,000. But over the next 5 years, you've got a whole bunch of maintenance. It's your regular maintenance you're going to be doing on the truck. And at the end of 5 years, you're going to sell the truck too, to recover the money. So when we take a look at it, when we take a look at saying, oh, let's say it's going to be 5% is going to be our interest rate. What does that do for us? Well, it gives us a net present value of $37,000. So for the next 5 years of your ownership and use of that truck, it's going to cost you $37,000. Let's take a look at the other truck, truck G. Again, purchase price $50,000. Not the same. Maintenance, roughly the same. And this one, on the other hand, has a sales price of $26,000 when you sell it at the end of the time that you had it. Again, rate of 5%. In this case, your net present value is $36,000. So, a little different. The truck F, net present value negative $37,000. Truck G, negative $36,000. Which truck would you pick? From a financial point? Toyota. Yeah, Toyota would be an option. But that's not included in what I'm doing here. So for the purposes of what we're doing here, it's going to be the truck G at negative $36,000 because it costs you less over the 5 years that you have it, either as your personal car or as the company car. And these tools can also be used for personal decisions. So, which is better? Well, there's some things I'll talk about a little bit later that might change your answer on that. Let's talk about a business example. This one actually has more applicability with what we do around here because it brings into account more of the things that you're looking for from a project standpoint. This particular project, I'm just saying, in this example, I'm saying, okay, let's start a consulting business. What is it gonna take to do that? And how am I going to, what's it gonna look like going forward? Well, in most cases, you have an income that you're going to be trying to be generating. And generally, most of the time when you're talking about creating a business, first thing that's gonna happen is your consulting income as a consultant, it's gonna be low in the first year and then it's gonna start to grow. So the question is, can I afford to go into business? You always have, in setting up examples for this, you always have your income. So you have various sources of income, and in a lot of the projects that you're working on, that's going to be either a mine concentrate or a metal or something that you can actually sell. So these same rules apply. And then you also have your total income. In this case, we're doing both. We're doing sales and consulting. And then you got your expenses. And since we're starting a business, first year, we're going to have a few expenses that don't repeat. You have to buy a new computer, you have to buy a desk, whatever. And then you have ongoing supplies that you're going to need, like paper, computers, not computers, printers, and consumables. You got your office rent, salaries for other employees. And so your total expenses in this case are about $85,000 to $88,000. And that compares against the total income. And if you take a look at the net income line at the bottom, and you sum all of those up, you end up with a internal rate of return of negative 9%. So, do we still want to start a business? Again, question. And this just shows what we were just talking about. At the end of year 5, since this is 0 here, still kind of questioning whether or not to start a business. But maybe we can make some changes and do a quick analysis and come up with a different answer. So, instead of our office rent on the other one, which was $18,000, nice office. Maybe we can find another office that's a little bit less expensive. What does this do to our results? Well, it changes it from a negative to a 7% return. So just by making a simple change in what we're spending money on, we're able to say, okay, maybe this is maybe this is not as bad a decision as I thought it was. So that helps. One of the concerns here, though, is you're still quite a ways out in terms of your crossing the 0 line. You're out between years 4.5 and 5. Is it possible? Yes. Is it better than the other option? Probably. And now let's talk about some of the advantages of these tools in general. First of all, net present value is considered superior to our internal rate of return because it shows the added value. So you're spending $1 million in a new project, and you have an internal rate of return of 7%. What that's doing is it's saying, okay, fine. In what I'm doing, I'm actually making more money than I had, and I'm benefiting myself. So you do have the advantage, the added value of 5% and an additional $50,000 over the $1 million that you started with. So it's an advantage. The NPV includes all relevant cash flows for the project. This one becomes very significant because when you're working with a project, some of the stuff is very obvious. You have various cash flows for, in the case of a concentrator plant, you have the chemicals, you have the electricity, you have a variety of obvious expenses that are there. But some of them may not be so obvious. So, for example, you have downtime. You have unforeseen repairs of equipment. These are again expenses that if you think through a project, you are able to account for in one way or another. Because you know equipment's going to either need maintenance or going to break, one of the two. So you can account for that in your financial calculations and come up with a better result of what you think the project has as a value. The NPV formula also accounts for planning patterns. In the two truck examples that I was speaking of earlier, you'll notice that I was able to say, okay, I'm going to buy it in year 0 and I'm going to sell it in year 5. Those are different cash flows and they're not consistent across the entirety of the calculation. So you can include things like that. So if you're looking at a project and say, okay, I'm going to do it at this size for 5 years, and in year 5, I'm going to increase the capacity of the plant for the next 5 years, you can account for that quite easily. And obviously, spreadsheets have become the standard go-to tool for most calculations like this, simply because it gives you the opportunity to do two things. It gives you the opportunity to put it in a form that you can actually read and understand without looking at the bottom line and doing some and seeing if you've got everything that you want in there. And for a firm considering investments in multiple projects, the NPVs of different projects can be aggregated. So for example, I was talking about $1 million project. Say you've got 2 of them that are at $500,000 each. Now you can combine those into a single $1 million project, if you will, and compare that directly with the $1 million project to see which one of those is going to be better. And this is one of the disadvantages. NPV, net present value, does not account for hidden costs and project size. So if you've got $1 million project or a $10 million project, net present value of both of those could be 8%. Okay, now which one would you pursue? Well, you don't know because you both have the same rate of return and you don't have enough information to do that. In addition to that, you've got, when you're talking about hidden costs, there are certain, these happen in every project. There are things that you simply don't know until they happen. And those costs can be, if you can think of them and add them into the analysis, you're better off. But at the same time, you may not be able to account for all of them. And NPV, one of the things that is a problem here, and it always has been, is when you take a look at the project itself, you're being asked to think about what's going to happen in the future. Not only from an operating plant standpoint, but from a financial standpoint. Am I going to be able to sell enough products to meet my expenses? Am I going to be making money? Am I going to be making money one year and not making money yet next year? There are variabilities there that until you get to that point, you may not know. And this is one of the key ones. It relies on a discount factor. And the question becomes, with the discount factor, how do you account for risk? That's usually one of the big ones. And in a lot of companies, what they'll do is they'll say, okay, my minimum expected rate of return is 10%. Oh, but this happens to be a risky project. So how do I account for that in the financials? Well, maybe I should take a look at the calculations at 15 or maybe 20%. Because I'm not sure if I'm actually going to be able to make the money that the project initially was slated for. So it gives you a tool that you can very It is a disadvantage, but at the same time, it can also be an advantage. And this one becomes very significant. The lack of consideration for non-financial metrics. Over the past, 20, 30 years, it's become more and more significant because we've taken a look at what we do with a lot of our projects and say, okay, now we have to account for the environment. Or if the mine's in a remote location, you may have social issues that you need to deal with. So how do you account for this? It's actually quite difficult because one of the things that happens is you don't have a good feel for costs that are involved, particularly with the environmental. You have tailings that you've been storing for years, in some cases decades. And, is there a way, do you need to do something with them? Do you need to clean them up? Do you need to remediate the site by removing them elsewhere? Do you need to, on the social side, what are you helping the local communities? What's the value of those? And in many cases, the value of that is hard to determine. And difficulty in comparing mutually exclusive projects. Say I've got this one project in South Africa, and I've got another project in Australia. Can I compare those two projects using these methods financially? Not really. Because they're really totally different projects, they're in physically different areas. And as an example, I was talking about using interest rates as a risk. The risk of a project in South Africa may be completely different than the risk of a project in Australia. So these are some of the things that you consider whenever you're working with these tools. So the question is, which one should I use? Well, the answer is probably both. And the reason for that being they give you different information. A very large project, a very large NPV, basically making a lot of money, but it may have a low IRR. So you may be making, $1 million a year, but in terms of the internal rate of return, it may not be so good. And in that case, it's possibly better to choose smaller projects. In the case, I said 3 here, but they have the same net present value overall and are able to give you a higher rate of return. So we've gone over all of the pieces, and I've covered all of the bits, including down to the limitations. And got a little quiz for you folks while we're at it. I'll let you read it, and I'll give you about a minute to figure it out. And I will be asking for a solution. Can be done. Okay. Time's up. Somebody have an answer? Some talking going on back there. Go ahead, Joseph.
You do 12 and 3 and 4 and 5. 12 and 3 for as much as you can in 5. So on 1 and 3, and empty out the 5. Then you put the 1 and 3 into the 5, 12 and 3 before that is 5.
And that is correct. That is the correct solution.
You can specify how large they are. You can afford the 3 to the 5 and 4 to the 9.
It's based off the.
We didn't specify that. It was, you didn't specify how large the containers are.
He's wrong.
No, you didn't specify how large the containers are. So was the part even fine?
Anyway, there's also, anyway.
I just.
Okay, this one doesn't have
That's fine.
anyway. That is the presentation. Questions?
I really like the presentation. Thank you for doing that. It is a great example for deterministic approach. But how about uncertainty? Do you think discount rate is enough for the determine the uncertainty? Because we have different costs for different project, and if we just give one straightforward discount rate, do you think it is enough, or should we create more stochastic approach to determine for the business?
The answer to that is, in my opinion, that yes, you're going to be creating more of a stochastic approach, because the numbers themselves, while they give you an answer, and part of this goes back to the discussion on social and environmental issues. There are things there that you have difficulty accounting for in your financial decision-making that have to be handled other ways. So in a lot of companies, there's a lot of discussion on exactly how to do that. Can you monetize something like environmental issues? Can you monetize social issues? Absolutely, because you can give them, you can build a framework that gives you a bit more of a solution along those lines. But at the end of the day, it's still going to be a situation of, well, okay, which is more important? Is it the economic value as calculated, or is there another set of criteria that you're making your decision based on?
Right, for diligence, essentially in the calculation, if you assume the cost to be constant, which is not escalation.
Correct. And that's one of the other issues with financial calculations in general, is costs do change over time. And in addition to that, when you start taking into account the time value of money, you've got two ways to go at it. Are you working with today's dollars, or are you working with future dollars? And then that also becomes part of the complexities of exactly what it is you're trying to calculate.
It seems that we have frozen both the revenue and the expenses.
For the purposes of this presentation, I just said everything is fixed and left it at that. But you're right, there are some changes that should be made if you were actually to do that as a financial calculation. Yes.
Thank you for the presentation, Dr. Mencin. I've used NPV and IRR, but shame on me, I didn't really know what they were. So thank you for learning me. And now I understand it better. I also, can you email this to the mining engineering grad students?
As I recall, it was included in the invitation, but I can email it to everybody.
Thank you.
Brock.
So, you've got these tools. How often would you estimate the tools you do an answer that actually takes for you?
To be fair, I would say quite frequently.
Well, that's ambiguous.
Well, okay. For me, these kind of tools are useful if it's truly, if you're limiting it to pretty much a financial decision. One of the ones that I've used more often than not is where I'm looking, in all of the consulting that I've done, is looking at a full-up financial model of a mine, of a process, ethanol plant would be a good example too. And trying to decide not so much along the lines of whether it's got a good NPV or a good internal rate of return, but how does that compare against my financing options? And this is getting into something that's much more complicated, because at that point, you're saying, okay, do I raise money by stock? Do I borrow money? Do I, where do my funds come from? And that, at that point, it becomes much more complex, both in terms of the calculations themselves and the modeling of the actual project.
Wouldn't you agree that a lot depends on how rigorous the data that you?
Yes, the degree of rigorousness is extremely important. If you want to have a valid situation or a valid set of computations that you're able to present to a board of directors, for example, or even just your manager, you definitely need to think through what the project is, how it's set up, and what are the determining criteria for making that project go or not go. Yes.
Question is, did you have a scenario that, IRR is positive and the NPV is negative? And this is what we do.
IRR is positive and NPV is negative.
Yeah, is it possible?
I don't think that's possible. I'd have to, I had not thought of that possibility and hadn't done any.
Well,
calculus.
implicit value equal to zero. Yeah. No, when you said implicit value equal to.
Net
Interest rate higher than IRR, both of them can be positive and NPV both negative.
Yeah.
Okay,
If interest is higher than IRR.
Let's see, let me try to remember. NPV, the IRR, okay, IRR is the percent that makes NPV zero.
correct.
Okay, IRR is the NPV, bare NPV. If you lose that IRR, NPV is good. Okay, so
So if your interest rate is less than IRR, and your NPV can be negative.
Or the NPV should have to be positive. Because the IRR is a loop. After the IRR, the NPV is negative. But we can put in the NPV as a loop after it has a IRR. But would you always reject the picture negative? Because I have analyzed the projection for NPV was negative, but the person was still justifying the fact that he wants to go ahead with the project. But you were saying that if the
well,
NPV
you can have negative NPV between zero and IRR. Okay, between zero and IRR, you can have negative NPVs.
Right. And in addition, remember when we were talking earlier, one of the things that I was talking about is there are other criteria that you may be making your decision on. This is just one tool, and it gives you literally just a financial view of it. There may be other reasons for it. And a good example of that would be a government setting up a program for any purpose. They may be spending money on it and they may be losing money on it, but they have a different reason for making that investment and that decision.
Or you can get the timeline, proceed with the project in 1 year.
So let me give you an example. IRR, a project has 18% IRR. Okay, if I use the discount rate 10%, NPV of that project is going to be negative.
Much further than the.
Everything else staying the same.
Right.
Okay. And the discount rate makes a big difference on your NPV.
Because my point is that it's also locked into the pay period as well. 5 years, 10 years, 20 years, depending on the time.
Payback period, payback period,
Or analysis period.
Analysis period, yeah, payback period, no.
So analysis period, if you extend it, that could be. But one thing that has always puzzled me, and you mentioned in your presentation, and I do hear it in financial report, that, like, let's say, a negative bond interest. I mean, it just blows my mind that you borrow money to someone and get less money back, and, you know, what the heck is that?
Well, that particular one, when you're talking about a negative bond, you're actually making a comparison there to what other options you have in the marketplace. So, you know, and a classic example of what you're talking about is, one that comes to mind is, if I'm borrowing money at a negative interest rate, so say, for example, it's -1%. Today I've got $1. Tomorrow I've got 99 cents.
Right.
But what is happening to the value of that amount of money relative to other goods and services in the market? So, for example, you know, today you may be buying something at $1, and a year from now, it may be 98 cents. At which point, going from $1 to 99 cents is actually a benefit, because it buys you more in the future year than it does.
But with that logic, if you keep your own dollar, it's still $1, not 99 cents, right?
Correct.
So it always puzzles me why in the bond market, you talk about negative bonds. Blows my mind. I have no idea how to finance it. And in the negative, in the case
Well-
of negative, interest rate.
At that point, you're also getting into inflation.
Yeah.
And that is always anybody's guess as to what's gonna happen there. In many cases, particularly, as an example in Japan, where they have had for quite a while negative interest rates, their inflation numbers reflect that same dynamic. Yes,
So I know you mentioned a little bit about discount rate. I remember learning in my economics class that discount rate is kind of an arbitrary value that kind of take, you can base it on stuff, but there's two general schools of thought in picking your discount rate. One is the economist's way, which is I'll maximize my return
right,
based on what's in the market, versus the financial, which is I want to minimize my loss. With your expertise and what you've seen being a consultant in the industry for more mining and petroleum and chemical engineering, do most companies prefer maximizing returns, or the economist way, or are they more on the financial way where it's like, I want to minimize my loss, so give me my 5% versus my 15 type stuff? What do you notice?
to be fair, it depends on the management of the company. And the reason I say that is because in many cases, the management over years, and this is particularly true in the mining industry, over the years, the sense of the management changes into it in the sense of exactly what it is they're trying to accomplish going forward as a company. In many cases, maximizing the return is playing into essentially shareholder value. The downside of that is, particularly in company management, is that it limits your ability to do future projects if you're maximizing the return for the benefit of the shareholders. On the other hand, if you're taking a look at it from the economist side, you know, you're looking more at the situation of, okay, how do I limit my risk? And that becomes the main part of the focus.
All of us. Which is your preferred?
That's on whether he's on the board, right?
Part of that is true. That gets into what's called fiduciary responsibility. And that is when you're dealing with other people's money. Personally, maximize. I'm on a board, it becomes very much a gray area because then it depends on exactly what the purpose and focus of the entity is.
You can also, you don't just have to present one case, you can present a base case, and then a bearish case, and a bullish case. And if they all are positive, then it's good, but then you have a little bit of a reference, right? So you can play around with it. You don't just have one thing.
Well, and in general, you're not presenting a negative case to your board anyway, because you know what they're gonna say. Anybody else?
Just, curiosity, have you ever used tornado charts or spider charts to justify this?
The answer is yes, and I've also used Monte Carlo simulations to do the same.
Do you think those are outdated?
No.
Thank you.
The reason being, your tornado charts and the like are,
I guess,
your,
what you could explain, but not
okay.
obvious. Sorry.
Not a problem. Tornado charts are basically, a way of showing what your changes are relative to a particular, variable in the calculations. And what it is the tornado chart is you pick a series of, financial bits out of what you're trying to present. And you say, okay, if I make this, if this increases by 10%, but if this decreases by 10%, what's the overall impact of that particular change to the overall calculations? And you do that, you pick, you can pick, feedstock quality as an example. Or you might say my reagent cost has a variability to it, or any number of things. And the tornado chart is just a stacking of the variabilities, with the largest one being on the top and the smallest one being at the bottom, hence the name tornado chart. Spider charts do something similar, but they present it in a slightly different graphical manner. Anybody else? Thank you.
Thank you so much. Welcome. Nice training. Thank you. Really enjoyed, some of us other reasons to revise some of the things that I forgot to do. So, one grateful for your comment. Thank you so much.
Thank you.
Yeah.